FactWire Report. Jobless claims fall as layoffs stay low. Mortgage rates slip to 6.23%. A divided Fed fuels a surge in rate hedging. Treasury challenges the Fed's rate control system. Watch to the end. One clean chart shows how rates hit housing, risk, and your wallet. Weekly unemployment claims in the United States fell again last week, reinforcing the picture of a labor market that is cooling gradually, not collapsing. According to the latest government report, new applications for jobless benefits for the week ending November 22nd dropped to about 216,000, down roughly 6,000 from the previous week and below what many economists had expected. Initial claims are one of the fastest indicators we have for layoffs. When these numbers spike, it usually means companies are cutting jobs quickly. When they drift sideways or edge lower, it suggests employers are holding on to workers, even if they are hiring more cautiously. Right now, claims are still in a range that historically lines up with a relatively healthy job market, especially considering that interest rates remain high compared with just a few years ago. To smooth out week-to-week noise, economists also look at the 4-week average of claims. That measure ticked down to roughly 224,000, showing that this is not just a one-off dip, but part of a broader pattern over the past month. At the same time, the number of people who stay on benefits for longer than a week has climbed to just under 2 million, a sign that once people lose a job, it can take more time to find a new one. This mixed picture matches what we see in the broader labor data. Employers recently added around 119,000 jobs in a month, a pace that is slower than the boom years but still positive. The unemployment rate is edged up to about 4.4%, its highest level in 4 years, as more people come back into the labor force looking for work. That combination, moderate job growth, slightly higher unemployment, and low layoff rates, points to a job market that is cooling rather than crashing. High-profile announcements from big employers, including logistics and technology giants, have raised anxiety about layoffs. But those cuts often roll out over weeks or months and may not yet show up fully in the weekly claims data. For now, small and mid-sized employers in many regions appear to be keeping staff in place, wary of how difficult it was to rehire after the pandemic period. For the Federal Reserve, these labor numbers matter as much as inflation data. A job market that is gradually softening without a sharp spike in layoffs gives policymakers more room to ease interest rates if inflation continues to slow, while still arguing that employment remains relatively strong. Financial markets have taken this week's data as another piece of evidence that rate cuts at the Fed's December 9-10 meeting remain on the table, though not guaranteed. For households, the message is more personal. If you already have a job, the risk of suddenly being laid off is still relatively low. If you are searching, it may take longer to land the next position, and competition can feel tougher. As we move into the end of the year, the balance between job security, wage growth, and borrowing costs will be crucial in deciding whether the U.S. economy slows gently or faces a rougher landing. With layoffs still historically low but job search is taking longer, the next piece of the puzzle is borrowing costs. Next, we look at how slightly lower mortgage rates are shaping confidence for home buyers and the broader housing market. The cost of a typical long-term home loan in the United States eased slightly this week, offering a bit of breathing room to buyers after 3 straight weeks of increases. According to mortgage buyer Freddie Mac, the average rate on a 30-year fixed mortgage slipped to about 6.23%, down from 6.26% the previous week. A year ago, that average was closer to 6.8%, and just 4 weeks ago it briefly touched 6.17%, the lowest level in more than a year. Shorter-term loans moved the same way. The average rate on a 15-year fixed mortgage, a popular choice for homeowners who are refinancing, declined to roughly 5.51% from 5.54%. That is still well above the ultra-low levels many borrowers locked in earlier in the decade, but it represents gradual progress compared with last year when 15-year loans were running above 6%. Behind these moves is the bond market. Mortgage rates tend to follow the yield on the 10-year U.S. Treasury note, which lenders use as a benchmark when pricing home loans. This week, that yield drifted down to around 4.01% from about 4.13% a week earlier, reflecting investors' expectations of slower growth, easing inflation, and the possibility of more interest rate cuts from the Federal Reserve in the months ahead. The Fed doesn't set mortgage rates directly. Its decisions on short-term interest rates influence borrowing costs throughout the economy, but long-term home loan rates also respond to how traders see the future. Recent Fed cuts, including one in September and another in October, helped pull market rates lower, yet officials have been careful not to promise a rapid series of reductions. Investors now largely expect another cut at the central bank's December 9-10 meeting, but housing economists warn that even a move like that may not translate into a sudden dramatic drop in mortgage rates. For households, the message is more personal. If you already have a job, the risk of suddenly being laid off is still relatively low. If you are searching, it may take longer to land the next position, and competition can feel tougher. This autumn, easing mortgage rates have already helped lift sales of previously occupied homes for several consecutive months, as some buyers stepped off the sidelines when costs retreated from peaks above 7%. Still, affordability remains a major hurdle. Home prices in many metro areas are near record highs after years of limited construction and intense competition. Even with rates off their recent peaks, the typical monthly payment for a new buyer is much higher than it was before 2023. That squeeze, combined with uncertainty about the broader economy and the job market, continues to keep overall home sales stuck around a 4 million per year pace, well below the roughly 5.2 million level that was common before the recent housing slowdown. Looking ahead, forecasters at major industry groups expect mortgage rates to decline gradually rather than in a straight line. Some projections suggest the average 30-year rate could move closer to 6% next year if inflation keeps easing and the Fed follows through with a careful, measured path of rate cuts. For households, that would mean a return to the ultra-cheap money of the early 2020s, but it could slowly widen the path to home ownership for buyers who are prepared and patient. For now, the housing market remains in a delicate balance, not frozen, but far from the boom years, with every small shift in borrowing costs closely watched by both buyers and sellers. As mortgage rates edge down and home buyers watch every fraction of a percent, traders are focused on something else, the Fed. Next, we examine how uncertainty inside the central bank is reshaping the huge market for interest rate hedging. Investors in U.S. interest rate markets are racing to protect themselves as uncertainty grows over the Federal Reserve's next moves, with the central bank sending mixed signals about when and how aggressively to cut rates. Trading in complex derivatives known as interest rate options has jumped sharply in recent weeks. According to market data cited by traders and analysts, volumes in swaptions, options on interest rate swaps, have swelled to roughly $887 billion so far this month, a notable increase compared with earlier in the year. At the same time, open interest in options linked to the Secured Overnight Financing Rate, or SOFR, has climbed, and implied volatility on short-dated contracts tied to longer-term swap rates has spiked. All of that points to investors paying up for insurance against the risk that the Fed's path diverges from their base case. Behind the surge is a Federal Reserve that is clearly divided. Some policymakers emphasize recent signs of softer job growth and argue that earlier rate cuts are needed to prevent unnecessary damage to the labor market. Others highlight core inflation that is still above the Fed's 2% goal and warn against easing too quickly. Though public speeches, interviews, and question-and-answer sessions have left markets with the impression that almost anything is possible at the upcoming December meeting, from another quarter-point cut to a pause. For now, rate futures suggest that traders see roughly an 85% chance of a cut at that meeting, up from about 50% just a week earlier. But the rush into options shows that many investors do not want to rely solely on those probabilities. By buying swaptions or SOFR options, they can hedge portfolios of government bonds, mortgage-backed securities, and corporate loans against sudden swings in yields if the Fed surprises in either direction. This hedging wave matters beyond the trading floor. When uncertainty about policy lingers, banks and large investors may be more cautious in extending credit or locking in long-term funding. That can make it a bit harder and more expensive for businesses and households to borrow even before the Fed takes its next formal decision. At the same time, the fact that investors are actively managing risk rather than simply betting on one outcome can help markets absorb surprises without the kind of extreme moves seen in past tightening cycles. For the Fed, the message is that communication is now almost as powerful as the rate decision itself. If officials continue to send conflicting signals, they risk amplifying volatility and forcing investors to spend more on protection. If the central bank can clarify its reaction function, how it responds to incoming data on inflation and jobs, it may be able to reduce the need for heavy hedging, even while keeping all options open. Until then, the options market is likely to remain busy as traders try to navigate a landscape where the direction of rates is broadly understood, but the timing and pace are very much up for debate. While traders hedge their bets on what the Fed will do next, the debate is not just inside markets. Up next, we look at how the U.S. Treasury Secretary is challenging the central bank system for steering short-term interest rates. U.S. Treasury Secretary Scott Bessent is turning up the pressure on the Federal Reserve's playbook for steering short-term interest rates. In a new interview, he argued that the central bank's current framework has become too complicated and may be starting to show its limits just as markets head into a typically volatile year-end period. Speaking to CNBC, Bessent said that monetary policy has grown very complicated and that the Fed should simplify things. His main concern is the so-called ample reserves regime the Fed has used since the global financial crisis. Under that system, the central bank keeps a very large balance sheet and relies on a network of standing facilities and administered rates instead of the tightly managed, scarce reserves approach that was in place before 2008. In practice, this means the Fed holds about $6.56 trillion in assets, mostly Treasury and mortgage-backed securities. Those holdings, combined with tools like the standing repo facility and the overnight reverse repo program, are designed to guide overnight rates into the target range, but recent strains have raised questions about how smoothly that system is working. In late October, conditions in short-term funding markets tightened enough that the Fed decided to halt the shrinkage of its balance sheet at the start of December to keep better control of the federal funds rate. At the same time, some eligible financial firms tapped the standing repo facility for notable amounts of cash, while others sent large sums into the Fed's reverse repo window. That push and pull underscored the challenge of judging how many reserves are truly ample for the financial system. It also highlighted the lingering stigma some firms feel about using Fed backstop tools, even when the official message is that they should be treated as routine parts of the toolkit. Bessent has long been critical of the Fed's large balance sheet. He and other skeptics, including Kansas City Fed President Jeffrey Schmidt, argued that such a big footprint can distort the price of long-term bonds, flatten parts of the yield curve, and blur the line between monetary and fiscal policy. The current framework has also turned the Fed from a profit-making institution to one running an accounting loss of around $240 billion, as it pays interest on reserves and overnight facilities. Those losses do not threaten the Fed's ability to operate, but they have become part of the political debate over its role. For now, many policymakers still support the ample reserve system, in part because much of it runs on autopilot and does not require constant market interventions. They warn that any move to wind it down would be wrenching. To return to a much smaller balance sheet, the Fed would likely have to sell large quantities of treasuries and mortgage-backed securities, a process that could drive borrowing costs sharply higher for households, businesses, and the government itself. Looking ahead, the Fed faces a tricky few weeks. Large Treasury settlements and typical year-end pressures on balance sheets could strain money market liquidity again, forcing the central bank to lean more heavily on its facilities. Officials are exploring ways to make the standing repo facility more attractive and may eventually need to expand the balance sheet again to keep the system supplied with enough cash. That would run directly against Bessent's push for a smaller, simpler framework, setting up an ongoing debate between the institution that sets interest rates and the Treasury Department that funds the government in those very same markets. That was FactWire Report. If this saved you time, subscribe, tap the bell, and like. Comment: jobless claims, mortgages, Fed uncertainty, or Treasury versus the Fed, which mattered most? Share with one friend who follows markets. We post concise, verified news daily. Stay to the end each time. Our closing chart turns headlines into signal, so you decide faster, calmer today.